Hey investors, I hope you're doing well. The stock market has been on a wild rally this year so far, with many investors profiting from significant gains. However, amidst all the green, there is a different story brewing. Not every company has been following the same glory of 2023's bullish run. In fact, some companies have found themselves struggling, hitting their lowest points in the last year. That's right, we're talking about stocks that are currently near their 52-week low today. Are these companies that are in deep trouble, or are there currently opportunities to capitalize on? That's what we'll be investigating today. The first stock of today is Walgreens Boots Alliance. Walgreens Boots Alliance is one of the prominent players in the healthcare and retail industry. This pharmaceutical giant operates a network of drugstores offering a range of health and wellness products, as well as prescription medications. With a presence in multiple countries, Walgreens Boots Alliance plays a significant role in the global healthcare ecosystem. If we look at the price action of Walgreens Boots Alliance, we can see that year to date they're down over 32%. And if we look in a longer time frame, of the past 5 years, it's down almost 64%. And in fact, if we look even further back, it's down still by 47%. In fact, the price currently is the same as it was in the global financial crisis of 2008, which is a very long time ago. The current dividend yield of Walgreens Boots Alliance is sitting at 7.6%, and the current PE ratio is a 6.3 PE ratio, which is quite low, but considering the industry that Walgreens Boots Alliance operates in, it's quite a normal PE ratio. If we look further into the dividends, we can see that their 5-year growth rate is pretty solid considering their yield, with a 5-year average growth rate of 3.2%. And of course, they have been paying dividends and increasing their dividends for 46 years, being just shy 4 years of becoming a dividend king. And the payout ratio is also quite low. If you see the dividend yield, that is 7.6%. They have a payout ratio of 46.6%, which means they still do have room left to increase their dividends further. If you look a little bit deeper into the dividend history, we can see that they have been, of course, increasing their dividends for a long time, and they've seen a very nice increase. Back in the 2000s, they paid out 3 cents a share, and this has gone up all the way to, 48 cents a share in 2023. It has flattened out a little bit, the growth has become less, but that's, of course, kind of normal. To look into the value of Walgreens Boots Alliance, we've performed a valuation using our stock valuation model. Which, first off, we are starting with the discounted cash flow model. In this model, we've imported the free cash flow of Walgreens Boots Alliance, and on average, this cash flow has grown by almost 6%, going from 2013 to 2022. I'm projecting a future growth rate in their free cash flow annually of 3% over the next 10 years, and with this percentage, we'll determine the future free cash flow for Walgreens Boots Alliance and determine a terminal year of valuation, using a perpetual growth rate of 3% and a discount rate of 9%. This gives us a sum of free cash flow of over $57 billion. To get our equity value, we then have to add the cash and equivalents and subtract the debt, giving us an equity value of $24.4 billion. And dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $28.36, which is almost a 12.5% upside. If we then move to the next model, which is the dividend discount model, I'll zoom in a little bit. We have imported the dividend payouts of Walgreens Boots Alliance over the past 5 years, and they have grown their dividends by an average of 1.2%, and I'm projecting all of their future dividends to grow by 1%. I'll be using a discount rate in this valuation of 9% once again, and this gives us a dividend discount model price per share of $24.24, which is almost a 4% downside out of this model. Moving on to the next valuation model, we have used Graham's revised valuation formula. In this model, we take a look at the earnings per share that Walgreens Boots Alliance is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory of Benjamin Graham that the PE of a company with no growth should never exceed 7. And if we look at all of these metrics, we get a price per share out of this model of $24.42, which is a 3% downside out of this model. Now we have 2 models left, and the next one is the multiple valuation, which we have not included. There's only one peer that you could compare Walgreens Boots Alliance to, which is CVS Health, but we won't fill in this model if there's only one company to benchmark it with. So we'll move into the last valuation model, which is the mean reversion theory. The mean reversion theory, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, we've imported the dividend yield of the past 5 years, and on average it has been sitting at 3.85%, while the current dividend yield is setting a lot higher at 7.26%. This makes it undervalued by this metric. Doing the same with the PE ratio, on average it has been sitting at 10.96, while the current PE ratio is sitting at 6.15, once again meaning that it's undervalued by this metric. This gives us a price per share out of this model of $46.23, which is over a 83% upside out of this model. And if we look at the final overview then, we can see that we have imported the valuation models, discounted cash flow, discounted dividend, Graham's valuation, and the mean reversion theory. And this gives us an average price per share of $30.81. But we have determined a margin of safety prior to this, with a standard margin of safety of 25%. Adding 5% for the EBIT growth, the margin growth, the debt to EBITDA and return on invested capital, we're left with a pretty huge margin of safety of 45%. Applying this margin of safety, we get a fair value of $21.25. And with the current price of $25, and it just changed, $25.18, we get an upside, which actually then is of course a downside of over 15%, indicating that's currently a sell. These margin of safety metrics are based on the declining EBIT that you can see over here, that has gone from $3.6 billion in 2013 to just over $3 billion in 2022, and the margin that has also been declining. Looking at 2013, the margin was 5%, and in 2022 it's 2%, so it has been decreasing, which is not a very good sign usually. So that's an explanation for why the margin of safety has increased on this. Let's go look at the next company of today. The second company on today's list is Disney. Disney, officially known as the Walt Disney Company, is a multinational entertainment conglomerate that operates in various sectors of the entertainment industry. Founded by Walt Disney and Roy Disney in 1923, the company has since become a global leader in entertainment. As we all know, Disney hasn't been doing that well this year, and year to date it's down by 5.4%. But if we look a little bit further and go back to 1 year, it's down over 28%, and you can go back to 10 years and it's actually up by 38%, but it comes very close to the prices that we have seen, well, almost 10 years ago. If we look at the earnings, it kind of explains why Disney hasn't been doing that well. The pandemic really hit them hard, and if we just look at their net income, we can see that it of course was negative in 2020 and has been slowly increasing in 21 and 2022, but it's nowhere close than what it was before the pandemic. If we compare Disney to the major indices like the S&P 500, we can see that it has massively underperformed it. Of course, the SPY year to date, if you look at the year to date, it's up by over 16%, while Disney is down almost 6%. And in 1 year, it hasn't done much better. Of course, SPY is still up almost 5%, but Disney is down over 29%. And over the long run, it hasn't done that much better. Up until 2021, it has actually done better with a return of 224%, but since the peak, since the all-time high, it has really begun dipping very hard, and it's at its 52-week low, well, even more than the 52-week low right now. If we look at the valuation, we can see that we have imported the free cash flow in, of course, a discounted cash flow analysis, and the average growth rate in their free cash flow annually during this period has been over 11%, and I'm projecting their future free cash flow to grow by 12%. And first, since the free cash flow is very low currently, I'm expecting this to restore quite well over the next few years, going back to the levels it has seen before the pandemic. After that, we'll apply this growth rate and then, of course, determine a terminal year of valuation using a perpetual growth rate of 2.5% and a discount rate of 8% in this valuation. This gives us a sum of free cash flow of almost $167 billion, and then to get an equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of over $130 billion. Dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $71.17, which is a 15.5% downside out of this model. The next model is the Graham's revised valuation formula. I'll once again zoom in a little bit. And in this model, we get the earnings per share that Disney is generating, which is $1.23 a share, the growth rate estimate of Wall Street, which is 19%, and the current yield of AAA corporate bonds in relation to, of course, the average yield of AAA corporate bonds. Out of this model, we then get a price per share of $27.97, which is a lot lower than the current price, which gives us a downside of this model of 67% almost. This is mainly because the growth rate of Disney isn't really that big. Well, it is quite big actually, what Wall Street is generating, but it's mainly that the PE is quite high for Disney, since they just came out of the pandemic and their earnings per share haven't been all that great. The next models are the multiples, and once again, just like with Walgreens Boots Alliance, there aren't that many companies you can really compare Disney with. Of course, you could say Netflix comes close, but it's not exactly what Disney does, and there's more things to it. So we'll skip this valuation model for Disney as well. If we look at the mean reversion theory, of course they don't pay dividends, so we'll only use the PE ratio in this valuation. The average PE ratio in this period has been sitting at 42.17, while the current PE ratio is sitting at 68.39. This gives us a price per share out of this model of $25.95, which is once again a huge downside of 69.17%. And if we look at the final overview of our valuation, we can see that only really the discounted cash flow has given a price that is remotely close to the current price. We get an average out of our models of $41.17, and then adding our 25% margin of safety, we get a fair value of only $33.36, which is incredibly low. This gives us a downside of over 60%, indicating of course a sell rating. This is mainly because these valuation models like Graham's and the mean reversion theory really heavily rely on good earnings per share, which is exactly what Disney has been lacking on currently. This gives us a very low valuation then, and of course we still get an increase in our margin of safety as well, with the margin having dropped significantly, going from 21% in 2013 to only 8% in 2022, which is not very great either, and this is why we increase our margin of safety as well. Let's go look at the next stock on today's list. The third stock of today is Leggett & Platt. Leggett & Platt is a diverse manufacturing company renowned for producing a wide array of components and engineered solutions. They play a crucial role in industries such as bedding, furniture, and industrial manufacturing by providing products like inner spring coils for mattresses, recliner mechanisms for furniture, and specialized components for various applications. Their innovations and manufacturing capabilities have a significant impact on the comfort and functionality of everyday products. If we look at the price action of Leggett & Platt, year to date it's down over 14%, and over the past year it's down even more, over 29%. If we look at a little bit of a longer time frame, it's still down by almost 40% in the past 5 years, and even on the 10-year time frame it's down over 3%. It means even if you invested in Leggett & Platt 10 years ago, you would be still down. But that is of course excluding dividends. And looking at the dividend yield, it's pretty nice. Dividend yield of Leggett & Platt is currently sitting at 6.6%. And if we dive a little bit deeper into these dividend statistics, we can see that Leggett & Platt has just become a dividend king with 50 years of consecutive dividend increases. The 5-year growth rate of Leggett & Platt in their dividends has been on average over 4%, but they currently have a payout ratio that is higher than their net income. This is usually a pretty bad sign, meaning that they will use or have to use cash or debt to pay out dividends, so this might be an indicator for a dividend cut that might be incoming. The dividend yield of course is 6.65%, which is quite a nice yield, but be aware they might have to cut their dividends. If you look at the valuation, we have imported of course the free cash flow of 2013 to 2022, and on average their free cash flow growth has been sitting at 27.7%, but this is mainly because their free cash flow dropped a lot in 2021 and then regained itself in 2022. So we'll only be going of an expected growth rate in the future free cash flow of 5%. And with this percentage will determine the future free cash flow for Leggett & Platt and determine a terminal year valuation using the perpetual growth rate of 3% and a discount rate of 9%. This gives us a sum of free cash flow of $6.4 billion, and to get our equity value we have to add the cash and equivalent and subtract the debt, giving us an equity value of $4.4 billion. Dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $33.43, which is a over 19% upside from the current price. If we look a bit further into the dividend discount model, if I zoom in a little bit, the average growth rate in their dividends in the past 5 years has been sitting at over 3%, but I'm projecting no future dividend increases since of course their payout ratio is currently very high. And we'll be using a discount rate of 9% once again in this valuation, giving us a dividend discount model price per share of $19.78, which is almost a 30% downside out of this model. If we move on to the Graham's revised valuation formula, we've of course imported the earnings per share of $1.70, the growth rate estimate projected by Wall Street, which is sitting at 5%, and the current yield of AAA corporate bonds, which is the same as all of the other companies. Out of this model then we get a price per share of $17.84, which is a 36.2% downside out of this model. Moving on to the multiples, this is the first company that we actually have some peers with, and we've imported the stock price and the earnings per share of some of the close competitors to Leggett & Platt. And this way we can determine the average PE multiple in the industry, which is sitting at 14.19. And all that's left to do then to get our fair value out of this model is to multiply by the earnings per share that Leggett & Platt is generating, which is the same $1.70 a share as the last model. This gives us a price per share of $24.13, which means it's 13.7% more expensive than the other companies, which of course is then the downside out of this model. If we take a look at the mean reversion theory, on average the yield has been sitting in the past 5 years at just over 4%, while the current yield is sitting at 6.49%, indicating that it's undervalued on this metric. Doing the same with the PE ratio, the average PE ratio of the past 5 years has been sitting at 16.55, while the current PE ratio is sitting at 16.44, meaning that it's pretty fairly priced out of this. This gives us a price per share out of this model of $36.28, which is almost a 30% upside of this model. If we then move on to the final overview, we can see that we have imported all of the valuation models and gotten an average price per share of $26.29. A margin of safety we have determined by using, of course, the standard margin of safety of 25% and adding 5% for the payout ratio and another 5% for the debt to EBITDA. This is because this payout ratio is currently above 100%, meaning that they cannot pay all of their dividends with their net income. And also their debt to EBITDA is quite high. It's over the 300% that we like to see. And if we look at this, that means that the company will need 3.5 years of their EBITDA to pay off all of their debt, which is considered quite high. This means that, of course, then we're adding 5% for both of these metrics, giving us a 35% margin of safety. Applying this margin of safety, we then get a price per share of $19.47. And with the current price of $27.97 a share, we get a downside of over 13%, indicating a sell once again, which is a recurring trend in this video. You'll see on the next company, which is not looking that much greater. The fourth stock of today is the Kellogg Company. Kellogg's is a well-known multinational food company that specializes in producing a wide range of breakfast cereals, snacks, and convenience foods. They are recognized for popular brands like Frosted Flakes, Corn Flakes, and Rice Krispies. Kellogg's products are staples in many households, offering convenient and nutritious breakfast and snack options to consumers worldwide. The stock is down by almost 14% year to date, and if we look at a little bit of a longer time frame, it's still down by almost 14%. In the last 10 years, you would only have seen a gain of 1.28%, which is not that great. They currently are offering a starting dividend yield of 3.92%, and they have been growing their dividends for 18 years now. Their growth rate, however, hasn't been that stunning, with an average 5-year growth rate of only 1.8%. But they do have a payout ratio of almost 55%, meaning that they do still have a lot of room to increase their dividends further. If we look at the valuation, we have imported once again the free cash flow of Kellogg's going from 2014 to 2022. The average growth rate in the free cash flow during this period has been over 6%. And I'm projecting their future free cash flow to grow by 6% annually. With this percentage, we'll determine the future free cash flow for Kellogg's and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This gives us a sum of free cash flow of just under $19 billion, and we have to add the cash and equivalent and subtract the debt, giving us an equity value of almost $12 billion. Dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $34.73, which is over a 40% downside of this model. If you look into the discounted dividend, it isn't looking that much better. The average dividend growth rate in their past 5 years has been sitting at 1.09%, and I'm projecting their future growth rate to continue with only a 1% growth rate in all of their future dividends. We'll be using a discount rate of 8.5% once again in this valuation, and this gives us a dividend discount model price per share of $31.78 a share, which is almost a downside of 50%. If we look at Graham's valuation, we've once again imported the earnings per share of the company. In this case for Kellogg's is $2.52 a share. And we imported the growth rate estimate projected by Wall Street, which for Kellogg's is 3%. This gives us, looking at all of these metrics, we get a price per share of $22.04, which is a downside of 64%. Looking at the multiples, we have, of course, for Kellogg's, we could find some similar companies. General Mills, Campbell Soup Company, and Kraft Heinz in this case, and we've imported their stock price and their earnings per share. This way, the average P multiple in the industry is determined at 15.1, and to get our price per share of this model, we have to multiply by the earnings per share of Kellogg's. This gives us a price per share of this model of $38.04, which is a downside of 38%. The last model that we have is the mean reversion theory, and on average, the dividend yield of the past 5 years has been sitting at 3.59%, while the current yield is sitting at 3.95%, and again that's undervalued by this metric. Doing the same with the PE ratio, the average PE ratio of the past 5 years has been sitting at 19.06, while the current PE ratio is sitting at 24.41, indicating that it's currently a little bit more expensive. This gives us a price per share of this model of $57.82, which is almost a 6% downside of this model. We then look at our final overview. We've imported, of course, all of the valuation models and gotten an average price per share of $36.88. Margin of safety we've determined using the standard margin of safety 25% and adding 5% for the dividend growth, payout ratio, debt to EBITDA, and deducting 5% for the margin growth, leaving us with this 35% margin of safety. Applying this margin of safety, we get a fair value of $27.32, and with the current price of $61.43, we get a massive downside of 55.5%, which is indicating a pretty big sell rating. Let's go look at the next stock of today's video. The next stock of today is Target. Target is a prominent retail company operating a vast network of stores offering a diverse range of products, including clothing, electronics, groceries, home goods, and more. Target is known for its convenient one-stop shopping experience and often collaborates with well-known brands and designers to provide a wide selection of high-quality products at competitive prices. It has a significant presence in the retail industry, serving customers with a broad array of shopping needs. As we all know, the stock hasn't been doing that well recently. Year to date, it's down over 19%, and if we look at a little bit of a longer time frame, we can see that this is a stock that has actually seen a nice increase in its share price over the past 5 years, unlike many of the other stocks that we've looked at today. Target has seen an increase of 41.5% in the past 5 years, and if we look back a little bit further, it has almost seen a gain of 94% in the past 10 years. If we look at the dividends, the current dividend yield that Target pays is 3.61%, and they are a dividend king with 54 years of consecutive dividend increases. And their 5-year growth rate is one of the higher ones in this video. It's probably actually the highest dividend growth rate that we will see in this video, which is almost sitting at 12%. And this is still with a payout ratio that is relatively low, only sitting at 59.34%. If you go look at our valuation model, we can see that the average growth rate in Target's free cash flow annually has actually been negative by a negative 4.42%. Since Target had a negative free cash flow in 2022, I'm projecting this free cash flow to recover in 2023 and 2024, and after that I'm expecting it to grow by 10% annually. Then with this we'll determine the future free cash flow for Target and determine a terminal year of valuation. And for this company we will be using a perpetual growth rate of 3% and a discount rate of 8%. This gives us a sum of free cash flow of $52.3 billion, and adding the cash and equivalent and subtracting the debt, we get an equity value of $35.8 billion. And dividing this by the amount of shares outstanding, out this model, then we get a price per share of $77.63, which is almost a downside of 37%. Looking at the dividends, we can see that the dividend increases over the past 5 years have been an average of almost 14%. Let me zoom in a little bit further, and I'm projecting all of their future dividends to grow by around 6%, and we'll once again be using a discount rate of 8% as valuation, giving us a dividend discount model price per share of $228.96, which is a 86.51% upside out of this model. Looking at Graham's revised valuation formula, we have imported the earnings per share that Target is generating and the growth rate estimate that Wall Street put them in, which is 18%. And looking at all of these metrics then, just like the previous companies we have done on this valuation model, we get a Graham's price per share of $159.42, which is almost an upside of 30%. Moving on to the multiples, we have imported 3 pairs, which are Walmart, Dollar General, and Kroger, and once again imported their stock price and their earnings per share, giving us the average P multiple in the industry sitting at 19.55. Multiplying this by the earnings per share that Target is generating, we get a multiple valuation price per share of $142.48, which is an upside of over 16%. And then lastly, we have the mean reversion theory, and the average yield of Target has been sitting at 2.29% in the past 5 years, while the current dividend yield stands at 3.5%. This indicates that it's undervalued on this metric, and doing the same with the PE ratio. On average, it has been sitting at 17.45, while the current PE ratio is sitting at 16.84, indicating that it's once again undervalued per this metric. This gives us a price per share of $157.49, which is an upside of over 28%. Looking then at our final overview, we have imported all of the valuation models and gotten an average price per share of $153.20. Applying the margin of safety of 20% that we've determined earlier using the standard margin of safety of 25%, adding 5% for the margin growth and deducting 10% for the dividend growth, we get a margin of safety of 20%. And applying this margin of safety, we get a fair value of $127.66. And with the current price of $122.81, we get a small upside of almost 4%, indicating that's a slight buy rating. Will this be the only buy rating in this video? Let's find out with the next company. And the last company of today is Macy's. Macy's is an American department store chain with a rich history dating back to the mid-19th century. It offers a wide range of products including clothing, accessories, cosmetics, home goods and more. With a strong presence in the retail industry, Macy's provides customers with a diverse shopping experience and has a reputation for carrying both popular and high-end brands, making it a popular destination for shoppers seeking quality products and fashion. The company is currently down by over 40% year to date. It really has been struggling this year. If we look back 5 years, we can see that it's down even more, by almost 67%, and looking at 10 years ago, it's down by even more, almost 73%. The company currently offers a yield of almost 5.5%, and they're sitting at a very low PE ratio of 4.3. If we look a little bit deeper into the dividends, we can see that the average growth rate in the past 5 years has actually been negative. They have had to cut their dividends by an average of 15.6%. Of course, giving them no consecutive years of dividend growth since they have to cut their dividends. Their payout ratio is very low, however, sitting at just over 20%, meaning that they should be able to increase their dividends further again. And their current dividend yield, of course, stands at 5.48%. If we look a bit further into the valuation models, first we have the discounted cash flow model, and we have imported the free cash flow of Macy's going from 2013 to 2022. The average growth rate in their free cash flow annually during this period has been sitting at almost 14%, and I'm projecting their future annual free cash flow to grow by 5%. And with this percentage, we'll determine the future free cash flow for Macy's and determine a terminal year evaluation, using a perpetual growth rate of 3% and a discount rate of 8.5% in this case. This gives us a sum of free cash flow of almost $5 billion, and to get our equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of $3.6 billion. Dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $13.26, which is an upside of almost 10%. Moving forward to the dividend discount model, we can see that the average growth rate in the dividends during this period has been sitting at 4.3%, and I'm projecting all of their future dividends to grow by 4%, and we'll once again be using a discount rate of 8.5% in this valuation, giving us a dividend discount model price per share of $15.02, which is almost an upside of 25%. Looking at the Graham's revised valuation formula, we've imported the earnings per share of Macy's and the growth rate estimate projected by Wall Street, which is no growth for Macy's in this case. And we've, of course, imported the current yield of AAA corporate bonds and the average yield of AAA corporate bonds as well. And looking at all of these metrics, we get a Graham's price per share of $15.86, which is an upside of almost 32%, seeing as they have quite a low PE ratio. Moving forward to the multiples, we haven't imported no multiples from Macy's since there were not that many comparable companies that I could find. Going then to the last model, which is the mean reversion theory. The average dividend yield of the past 5 years has been sitting at 7.42, while the current yield is sitting at 5.37, indicating that you could consider it to be overvalued on this metric. Doing the same with the PE ratio, on average it has been sitting at 6.95, while the current PE ratio is sitting at 4.66, indicating that it's undervalued on this metric, giving us a price per share out of this model of $13.34, which is an almost 11% upside from the current price. If we then look at the final overview of our valuation, we can see that we get an average price per share of $14.37, but once again we have a big margin of safety on this company as well. We've started with the same standard margin of safety as all of the other models in this video, and we have added 5% for the EBIT growth, margin growth, and dividend growth. and deducted it by 5% for the payout ratio and debt to EBITDA, giving us a margin of safety of 30%. Applying this margin of safety, we get a fair value of $11.05, and with the current price of $12.04, we get a downside of 8.2%, meaning that there's an 8.2% premium added to the price. This indicates that it's still relatively close to fair value, but it's not quite a buy yet, and of course then we still get a sell rating. If you'd like to see more of these kind of videos in the future, let me know in the comments, and be sure to hit the subscribe button to never miss out on any of the future videos that I'm going to be posting. Thanks for watching.